Hello everyone, my name is Viren Dayal. I am a custom broker and a logistics skill council certified trainer in customs law, applied rules and regulations.
For latest updates, subscribe to our channel and press the bell icon.
In this series, in part 2, I am now going to talk about and discuss the Customs and Central Excise Duties Rules 2017, which relate to Section 75 of the Customs Act 1962. In part 1, I have discussed when goods are imported into India and duties are paid and they are re-exported, what are the legal provisions and in what way can you get back the drawback. In this particular series, which is part 2, I am going to discuss and give you more information on goods which are manufactured in India, whether or not imported material has been used, but they have been manufactured even by taking excise materials and so on. You are entitled to drawback under the provisions of Section 75 and the rules which have been framed thereunder, namely the Customs and Central Excise Duty Drawback Rules 2017. So what is the definition of drawback under these rules? So drawback would include rebate on goods manufactured in India, excluding integrated tax paid under Section 3, subsection 7 of the Customs Act, and excludes integrated tax levied under Section 3, subsection 7 of the Customs Tariff Act 1975 and the GST compensation cess levied under Section 3, subsection 9 of the Customs Tariff Act. Here the word is rebate. Government gives you back most of the duties which you have suffered when the goods are manufactured in India. Vis-a-vis, under Section 74, the definition of drawback included the word refund. Under Section 74, you are entitled to the full refund, but of course up to a limitation of 98%. And under Section 75, it is known as a rebate of duties suffered when goods are manufactured in India and they are exported. Let us now further study what this means in terms of rebate. The government, after every budgetary changes which took place, would review the drawback which is available and will consider various inputs and the average incidence of duty suffered in various kinds of goods which are manufactured in India, and after that, by way of a notification in the official gazette, drawback rates from chapter 1 to chapter 98 are assigned, giving at the percentage, that is ad valorem, or with a value cap, or it could be even specific in some cases. The drawback so announced is based on the HSN code of the 6-digit code which the exporter has to identify which particular code belongs to him when the goods are exported. For example, if you are exporting cloth, then it comes under chapter 62 and so on. So these are the drawback rates which talk about rebate of duties when the goods are exported into India, but excludes the integrated tax. After 1/7/2017, when the concept of IGST has been introduced, then the IGST element is refunded in full to the exporter, and therefore the rates of drawback have now been narrowed down to rather very bare minimum or much lower than what it used to be earlier. However, their rebate is given to us under Rule 3, Rule 4 or Rule 5 of the Customs and Central Excise Duty Drawback Rules 2017. Consider average incidence of duty suffered for various inputs in the goods which are manufactured. So this is how drawback is taken when the goods are exported from India and the exporter files a shipping bill for drawback, and depending upon what his HSN code is, or the 6-digit HSN code, accordingly the drawback rates are mapped from the available notification. There is another concept in drawback. Therefore, the rates are notified by the government considering the budgetary changes as discussed, and accordingly the exporter will continue to take the rebate of by filing a drawback shipping bill under section 75. There is another concept of drawback which is known as a brand rate. The word brand rate here indicates that an exporter has suffered certain duties and his product is not covered in the notified or the notification given by the central government under rule 3, 4 and 5, but he has suffered duties and therefore he can file a brand rate at the jurisdictional customs office from where he has exported, giving all the relevant details of the taxes incurred and paid, and it also allows the central government or the commissioner of customs or the principal commissioner of customs has power to check the records and ask for more information to ascertain the amount of duties suffered, and after that the brand rate is also available to that particular exporter, either shipping bill wise or product wise. So this is the second way by which the exporter can get back drawback. The third way in which the drawback can be claimed by the exporter is under rule 7 of these rules, and that is known as by a special brand rate. Here the notification has published various duties in which the exporter's product is covered, but the exporter claims that the total duties suffered by him are more than 80% of the rates published in the notification under rule 3. In that case he can claim a special brand rate under the Customs Act 1962 and under these rules. So all in all, you can claim drawback under section 75 by the all industry rate, which is published under rule 3, 4 and 5 by way of a notification. You can go for brand rate fixation under rule 6 in case your product is not covered under this rule 3, rule 4 and rule 5 notification, or if the amount of duty suffered by you is more than 80% of the notification which publishes various rates, then you can apply for a special brand rate under rule 7. These rules also talk about some other features which you should know. So rule 8 and rule 9 talk about what is the maximum rate of drawback you can get. So under rule 8, when you applied for a brand rate or a special brand rate, you will not get a rebate of drawback in case the value of the imported material which you have used in manufacturing of the goods is less than the FOB value of exports. And under rule 9, where the central government has published the rates under rule 3, 4 and 5 by way of a notification, the drawback cap is limited to 1/3 of the market value of the goods and not more than that. Another interesting feature of these rules is that the central government or the PC or the CC can check your books of accounts, can ascertain how various duties have been suffered before any rate is prescribed to you. There is also a provision to take supplementary drawback in case the drawback determined is low, or the government gives a retrospective notification that certain categories of goods new rates have been published from so and so date. That facility is also covered under the rules. But the most striking feature of these rules is that the government gives you or sanctions you drawback within the stipulated time of 30 days from the day in which the shipping bill is returned to the proper officer after let export order under section 51. But if you do not receive the foreign currency as per time stipulated under FEMA, currently 9 months, now it has been further revised, then you have to return the drawback to the government by not only paying back the drawback but also paying interest at the rate of 15%, which is covered under section 28AA, from the day on which your bank account was credited with the drawback till the payment of the drawback to the government. And therefore drawback is now mapped with the amount of foreign currency you earn under the Customs Act and the FEMA regulations. However, if the exporter has taken a cover from Export Credit and Guarantee Corporation of India, ECGC cover, insurance cover, and the Indian Embassy or the foreign embassy, the Indian Embassy in that particular country certifies that the amount will not be received in India, then RBI will write off the amount as not recoverable in foreign currency, and in such cases the drawback which has been paid to us need not be refunded. And last point for this particular topic is that the drawback which we are getting under section 74 or under section 75 is determined, paid under the Customs Act, and the drawback rates are fixed by the Directorate of Drawback at New Delhi. Now I talk about interest on drawback. If the drawback is not received to you within 30 days, either under section 74 or under section 75, the government will pay you interest at the rate of 6%, which has been notified under section 27A, from the 31st day till the date of drawback. Also, in some cases where the amount of drawback is erroneously received or received in excess, or where the drawback now becomes due because the money is not been realized in foreign currency within 9 months or any extension given by RBI, in such cases it must be paid within 2 months to the government from the date of payment, along with interest at the rate of 15%, or else it will become arrears of land revenue and the amount due to central government. And under section 142, recovery proceedings can be done, and the district collector can take all necessary action to attach the property and recover the drawback amount and the interest.
For detailed learning of all logistics subjects, visit www.logiveda.com.